All right, so welcome back to the fourth installment in how to really grow a small trading account. And what I'm focusing on is all of the things that you need to know that's going to help you get to the next level that aren't good marketing tools. So most of the people selling education and selling things, they're not going to bring this in because this can honestly run people away. You know, knowing what it really takes in order to be successful would probably run half the people away that, buy these services. So I really want to spend some time and share with you the information that you're really going to need to know and focus on, in order to get to the next level. So let's quickly review what we talked about last week, and then we're going to move into what we're going to be discussing this week. So last week we talked about the process approach to trading and how important developing a process not just to trading but to your learning. Understanding that your learning is a process. We talked about making small, consistent steps and then mastering the basics, making sure you have a good foundation, that you don't just start trying to trade and then build on top of that. Because if you remember the triangle that we talked about, if you just start trading out of the gate and then start trying to add stuff on top of that, you're going to try to balance everything on that little point on the triangle. And it's going to be very difficult to do. And it won't be long before it tilts one way, one side to the other, and you fall over. We talked about reflection and the trading journal, and I'm going to show you this week. You're going to see how that really falls into play, or how it comes into play. We looked at this. We talked about not being result oriented, and that's where a lot of people are focused, because that's what is marketed to you. You can make $200 a day, you can make $250 a day, or you can make $1,000 a week. And everybody focuses on the outcome, but you need to focus on the actual process that you use to make the trade. And if the trade worked, make sure that you reflect on what you did so that you can repeat it the next time. Or if you broke the rules, you need to come up with a way to keep you from breaking the rules the next time. So I think this was a very powerful, illustration of the difference between a beginner trader, a new trader, who's just focusing on, the results, versus the professional trader, experienced trader, who's focusing on the actual trade, who's focusing on their skill development. So today, we're going to talk about the anatomy of taking the trade. And we all know that when you're trading in a small account, it's going to be a little bit different. There's certain things that you may not be able to do when you have a limited account. But from somebody who has traded both the small accounts and large accounts, I honestly feel that it's an advantage to start out with a small account, because it forces you to really focus and really develop the skill if you're going to be successful. So starting a small account and you really don't have the drive and determination and the dedication to do what it takes to grow your small account, it's going to save you from losing a lot of money. If you come back and you just throw a bunch of money into an account and just trade without concern, you're going to end up losing a lot more money. For me, and that's one of the things that I did, and it was kind of inadvertent. It wasn't really my plan at the time. Starting with $1,500 and then not adding to it. I could have kept working. I could have put more money in and just kept adding to it. But I kept it to a certain level so that I could only lose but so much while I was learning. Yes, I am trading. Yes, I am recording. I think I'm losing my mind. Yeah. Yes, I'm recording. All right, so I don't even know where I was. But we're going to look at the anatomy of a trade. Now, I use this same anatomy with swing trading. So in the swing trading class, we kind of use the same anatomy to make a trade. But what happens is going to be a little bit different as we go through this. But I want you to understand there's certain ways that you have to manage a small account. And yeah, I was talking about the advantages. Yeah, I'm glad you helped me remember. Well, I don't know where I am today. But, because it is different. And it forces you to develop the skill that you need. Because you're going to have to be consistent to grow your account. You can't be all over the place. You can't do good this week and then next week give back money. Do good this week, next week give back money. You have to go through these steps and go through these cycles in order to get to consistency. So today I'm going to walk you through how I plan a trade. What I'm thinking, and from the beginning to the end. So you have an idea of how you need to approach a trade. It's hard sometimes just not saying anything and just being quiet in chat. But I don't want to start talking about all of these things and get people excited about wanting to take trades. Because days like today, there was no reason to take trades after 10 o'clock or 10:30. I'd say 10:30. If you weren't in a trade by 10:30, the market just wasn't there. Now, if you're going to be a scalper, it's kind of hard to do with a small account. But scalpers can live all day long. But for us, if we're trying to find a trend following move that's going to give us a significant gain, days like today, you just won't see it after the open. And then at the open, it's going to be limited. There's limited follow through. So we'll get into that a little bit later here. So the first thing you want to do is scan. And this is what I look at every morning. And you see when I'm building my watch list. So once we get that watch list together, that's, I'm looking at the scan. I'm vetting the stocks. I'm analyzing the charts. I'm looking for key areas of support and resistance. And that's going to help me determine what stocks are going to be in play that day. Now, the worst thing you can do is exhaust your scan and then start looking at stocks other people are calling out. That's the worst thing you can do. Your scan is designed to bring you stocks that meet your criteria. If there are no stocks in the market that day that meet your criteria, that's ideal for your setup, then you don't trade. You skip that day. If you only have one setup. If you have two setups, then you can move on to the next one. Like in my case, if I don't have a stock that I feel good about setting up for opening range trade, I'm not trading the opening range. I'm going to wait until I get a stock that was on my scan that may be setting up for a secondary move, or something that hits the scan that may set up for a trend continuation. But I'm not going looking. It's whatever your scan is set at, whatever you use to find your stocks, that's what you need to stick with. And if there's nothing in the market coming to you, you take the day off. Or if you really want to trade, paper trade. Save your money. Because scanning is one of the most important skills that you have to master as a trader. You're in scanning, you're filtering out all of this unnecessary noise. There's well over 2,000 stocks trading on any given day. Not all of them are tradable. And only a select few are going to be tradable for the strategy that you're looking to trade. So in order to find that, scanning is the best way to do it. And there's several ways you can do it. And obviously the best way is to get some type of scanning software or use a website that allows you to use your own screeners to find the stocks that meet your criteria. Others, they use crowdsourcing, Twitter, stock tweets. You may find somebody that trades similar to you or that you like their style and you've learned and understand how they trade. You could go on and look for stocks from that guy. Or you may have a group of people that you trust and you just want to see what they're doing. Twitter, there's a lot of people who find their trades on Twitter, on stock twits. I was surprised, but some people do it. I think it's, unless you have a solid source, unless there's somebody that that may be scanning and putting out their watch list, I would be kind of skeptical about that. Then you have chat rooms and you have alert services. And in chat rooms, you're always going to have people who are part of other chat rooms that may be calling out trades that other people are taking, and they're posting it in chat or whatever. You have to make sure you understand what strategy they're trading. And if this stock does not meet the criteria for your strategy, it probably won't end well for you. So the key in scanning is to make sure that you're only taking in the stocks that meet your criteria. However you do it. Don't change anything. If you have a day like today and it's not good, you didn't see me going chasing the market. You didn't see me chasing out the stocks other people were posting, because that's not a good habit to get into. Okay, scanning is not perfect, but it's going to give you the best chance at finding stocks that align with your setup. Some people scan the night before. That's fine. I used to do that. But I realized after a while, it worked great when the market was good. But once the market started getting a little soft, a lot of the stocks that I found the night before weren't hitting in the morning. They didn't have volume. They weren't making a move. So now I wake up that morning and I use my trade idea scan to find the stocks that are actually moving that morning. So I'm to build my morning watch list, the stocks that I'm gonna look to trade at the open and potentially throughout the day. I'm gonna use my scanner in the morning. Now there may be a stock that I bring over from the previous day. Like today I was watching AAP again because I didn't know if we were going to trade an inside day where we had a little recovery and then we start to go back down tomorrow, or whether we were going to continue and retest the bottom of that gap again. So I didn't know. So I had to wait and see what it was going to do. And yeah, all day long I was waiting for it to roll over. And at the end of the day, I only got 60, 70 cents out of it. I waited all day for it. It just didn't happen. But this wasn't on my scan this morning. It wasn't on the scanners this morning. But it was something I brought from the night before. So that doesn't always work out. So my suggestion is, if you're going to day trade, and we're day trading momentum stocks that are moving, that have volume, that have catalyst, those you're going to find first thing in the morning. Now, if they post the night before and they're going to be in play today, then they're going to hit the scan in the morning anyway. So why not just wait till tomorrow morning and pick your stocks? And that's what I do. But like I said, it's really up to you. It's what's comfortable for you. There was a time where I didn't have time in the morning to scan, so I had to do it at night. So you may have to do it at night. You may not have the ability to do it in the morning. So, however, it's really, I'm not telling you what's law. I'm telling you what I feel is the best. But obviously, you're gonna have to adjust, to your personal schedule and your personal preference. We also do intraday scanning. That's where I'm scanning for reversals. I'm looking at stocks that are meeting, hitting RSI extremes to see if they're set up for maybe a trend continuation or something. But we're using those scans. I'm not looking at Twitter or stock tweets or anything, and let's say somebody from another room, another moderator from another room throws out a stock and says, "Hey, let's watch Snap. We think Snap's gonna roll over. I'm gonna load up here." And I'm like, "Yeah, Snap looks good. Let's load up." So I don't know what load up means. Are you loading up long? Are you loading up short? What strategy are you looking at? What do you know that I don't know? So it doesn't make sense to do that. So I always use my intraday scanning. If somebody in chat mentions a stock, they want me to look at it, and I look at it and I vet it. If it looks good to me for my setup, then yeah, I may trade that. But I know to go through the process to see if it's gonna meet my criteria. So it's very important for you to find stocks with the best chance of setting up with your trading strategy. So scanning is very, very, very important, because if you're not in the right stocks, you're never going to make money. If the watch list I come up with every day if none of them work, I never make money. Today TGT worked a little bit. We got one move. I probably should have taken it all off, knowing what kind of day we had coming, but I didn't. I tried to scale out of it and kind of limited the profit I got on it. URBN made a solid move. It just took a long time to grind down, and it eventually, made the move. But if we didn't have a scan and I didn't have those stocks that were moving and that gave us the potential, we had no chance of making money. So our goal really with scanning is to make sure we find stocks with the best chance of setting up with your strategy. So to give you an example, open and range strategy, everybody knows that's what I trade at the open. And I'm just simply looking for stocks that have gapped up or down at least $1, the pre-market volume of at least 50,000 shares, the daily average true range. I use the daily chart to figure the average true range for of at least 50 cents. The price has to be over $10, and the float has to be less than 500 million. That's all I'm looking for. That's what my scan is looking for in the morning. So if a stock is gapped up or down at least $1 and it doesn't even have 50,000 shares of volume, it's not going to hit my scan, and I'm probably not going to watch it or even look at it until it gets some volume. If the ATR is like 12 cents or 15 cents, I'm not going to look at it, because even if it does have a catalyst, the movements are going to be limited on that thing. Unless it's really getting pumped or, there's something out of the ordinary. And, I like stocks over $10 because they give us the larger range moves. And then I don't like very low float, but I don't like very high floats either. Now, I will trade a higher float stock. It really depends. It has to be a stock that has the ability to run. And it has to have shown that ability to make big moves. And then I would trade it. But it's very, very important. I can't stress the importance of scanning, or if you're going to get your stocks from a service or somebody, make sure that that those stocks meet your criteria. Because if they don't, you're going to have a hard time making money trading it. Alright, so once we scan the stock, now it's time to plan. This is very, very important. We should never take a trade unless we have a plan in place. If we don't have a full plan, meaning we haven't established what our risk is going to be, how much money are you willing to risk on this trade? That's going to be, whatever percent of your account you're willing to risk per trade. This is going to be the max loss that you're willing to take on any given trade. And this is what you're going to use to set your hard stop with. And when you're new, and even when you're not new, I've been trading for years, and I still need to put in a hard stop, because I will convince myself I know more than what I do know. And nobody knows what the market is going to do. But sometimes I can convince myself that I know what the market is going to do and not stick to my max loss stop and lose more money. When you're trading a small account, you have to protect your capital. Number one, you can't risk but so much. Now, on a $3,000 account, I'm risking 3%, which is $90. So I'm risking between $90 and $100 per trade. Now, that's all I'm risking. And even though my account grows throughout the month, I'm still only risking 3%. Whatever I start the month with, that's the risk that I'm using. So next quarter, when I start trading with $5,000 a month, then my stop's going to be 3% of my $5,000 account. So that's going to be my max loss. So we have to establish, this is not where you're going to set your stop loss based on technical levels on the chart. This is just what you should set a hard stop at, so that if the trade gets away from you, you won't have that deer in the headlight look watching the stock run away from you and draining your account. If you understand what I'm talking about. Some of you may have been through that before, but you want to make sure that you have some type of way to protect yourself in case the trade gets away from you. So before you do any plan, you need to know what your risk is going to be anytime you plan a trade. Okay, the next thing you're going to look at is your entry point. You got to have set criteria that's going to trigger an entry. So, for example, on my 5-minute open range breakout setup, I'm looking for the first candle to break the opening range low. So let me see if I can bring up a chart real quick. All right. And what did I trade today? I know I want to forget it, but I traded TGT, didn't I? What did I trade? At the open. Man, I tell you what. I'm out of sorts today, guys. All right, so this isn't a good example. Let me get this is a better example. That didn't even get out of the... Okay, so let's say, just to say for the sake of argument, do I have yesterday's trade on here? All right, we can use yesterday's. Okay, let's say for the sake of argument, this is actually the trade I took yesterday. So my plan is, I'm trading the 5-minute opening range breakout or breakdown. Okay, so my plan is, my entry strategy on this deal is to get in the trade, to enter as soon as we break the opening range low. So once this set, it doesn't show for the previous day. That's why it's not working. It only shows for the current day. So I'm gonna have to do this manually. So once the opening range low is set, once this candle breaks it, let's say this is 89.53, I may put an order in at 89.50, or I may mark it in, just depending on, how I feel. So what I'm doing is, I know my entry strategy. My entry strategy is the break of the 5-minute open range low. Now, if the market is not really good, if the market is very slow, and I don't see a whole lot of activity, okay, then I'm gonna switch to my more conservative entry, which is I'm gonna let one candle close below the 5-minute opening range, and then I'm gonna get in the next candle as it breaks. So I'm giving it time to confirm a move below the 5-minute opening range. But in either case, I have an entry strategy. And I need to know exactly what I'm going to do when the trade comes about. Am I going to enter as soon as I break the opening range low? Or am I going to wait until I get a candle to close below the opening range low and then get in? Mike, it depends. Whether the opening range depends on the size of the wick. Alright, if we had a wick this long on the first 5-minute candle, then I'm just going to defer to the body. If we just had a little wick, something like this, then, I would probably defer to the wick. But just depends on the length of the wick. But that's the first thing, that's the next thing you do. I knew when I got in this trade, my risk was $100. I already knew that. So that's when I set my max loss stop. When you see me set my hard stop, that's not a technical stop. That's the most that I'm willing to risk on the trade. That means if it decides to take off and go back and retest the level, and I get taken out, then I get taken out. That's my max loss. I don't need to remove it. I don't need to do anything. And one of the things that you guys, if you've been here for several months, you see having those stops in place is what helps me end up with a profit. I could lose on 2 or 3 trades, win on 2, and I got my profit because I managed my loss. And Simon brought up another point. Once you set your hard stop, you cannot focus on losing. No matter what happens with that trade, the max you're going to lose is X amount of dollars. So you don't even have to worry about that anymore. That takes a lot off your back. It's just like I'll tell you, don't look at your P&L. Don't watch your P&L. All of that stuff, it just takes so much off your back, and you can focus 100% on the trade. And we'll talk a little bit more about that here in a few. But I just wanted to tell you, you've got to have an entry strategy. Because I'm going to tell you, I used to have the strategy that I was going to trade. And when the bell rang, I didn't even know how to enter the trade. I knew the strategy, but I didn't know what I was looking for to enter. I knew what I wanted the trade to do. But where am I going to enter the trade? You know, that was, my big thing. So if you have trouble remembering this stuff, take a note card and jot these down. I used to have a note card for each trade, and some days I still do it when I have a lot going on and I don't want to forget something. I'll write on the note card what my risk is for that trade, what my entry trigger is going to be. And then once you figure your entry trigger, you want to find your technical stop, because your entry is going to be based off of some type of technical level. And let's go back to this chart again. So my entry, if I'm looking at this trade, now my entry is going to be based on the breaking of the 5-minute opening range low, which is, let's say, 83.57. Okay, that's the opening range low. That's what I'm basing the trade off of. If I get in this trade and this stock goes down and pulls back and closes back above this level, and I'm saying, and I made a decision at the beginning to base my trade off of this level, then I need to stop out. I don't need to wait for it to hit my max loss stop. I need to go ahead and stop out. If I'm going to use the VWAP, and the VWAP is what I used on this trade yesterday. I got in and I would get in on a close above VWAP, because I know there are times where stocks will pull back and retest VWAP and then fall on through. So in this case, I got in at 89, I can't remember, let's just say 89.50. I got an entry at 89.50. My stop at 100 shares, my max loss is $100. So my stop's going to be back up here at 90.50. Let me do some arrows here. So I'm going to enter right here at 89.50. Let's make it big so you can see it. My stop is going to be $1 away, because 100 shares times $1 is $100. Oh, I can make the arrow whatever price I want. So I want my stop to be 90.50. So that's my technical stop. This is my hard stop. Okay, so if the stock took off and went away from me, the max I'm going to lose is $100. I don't have to worry about anything anymore. Now, if the stock came up and it closed above the VWAP here, then technically this trade is dead. It closed above the 5-minute opening range low. It closed above the VWAP. Even though it didn't hit my hard stop, my max loss stop, I still need to take it off. So if I can only lose, say, $60, why would I just sit here and lose $100 when I could take it off at 60, and if it sets up again, I could get back in and take the trade, and I won't be so deep in the hole because I just sat there and let it hit my hard stop. So you're going to have a technical working stop, something that you're going to have in your mind that if this level breaks, the trade is dead. And that's where we're going to look to set that stop as soon as we, before we enter. All right. So that's going to be the technical stop. It could be VWAP, moving averages, daily levels. If that's the closest thing to it that you want to use, it could be a daily level. Whatever the case is, you need to have some type of technical stop to let you know that the trade is not in play anymore. And you'll hear me say several times that, this trade is in play. Then, that means that it hasn't breached the technical level that I'm basing the trade off of. Then you want to look and you want to define your profit targets and exit points. You want to have those planned out as well. You don't want to get in a trade and then try to figure out where your profit targets are. Because what if you get in a trade, you're risking, let's say on your technical stop, you may be risking 60 cents. But your first, the first defined profit target that you see, the first level you come to where the stock may bounce is 20 cents away. Does that make sense to take that trade? You're risking 60 cents to make 20 cents on your first cover. It doesn't, so you gotta define your profit targets as well before you even take the trade. So let's go back. Let's look at this chart one more time. Okay, so let's say this is my entry. Okay, 89.50. My first profit target is going to be right here, 88.74. My next logical profit target is probably going to be the whole dollar mark. Maybe a flush through the whole dollar mark. Somewhere in here. If I don't have any daily levels, I'm going to use whole and half dollar marks, because that's where you're going to run into a wall of buyers and sellers. We call it a supply zone. These are psychological areas on the chart where buyers and sellers will hang out. And these are ideal places to take profit along the way. Now, here's a question. What if I only took 50 shares here at 88.53? At 89.50, I only took 50 shares. Okay, and this is less than $1 away. What do I do? Well, this is a decision you have to make before you take the trade. Do you want to hold out? Do you want to take it here? Or do you want to hold out until you get to the whole dollar mark? Let's say you got in at 89.53, and let's say you want to see if it gets below 89.50, 88.50. You can take it off at 88.50. Just know that if you're in that small, you may not be able to scale out. You may just have to take it off at the first target. So in that case, you want to make sure that your risk does not exceed where you're going to get your first, where your first target's going to be. You don't want to risk $1 and your first target is 80 cents. It doesn't. Then in that case, this trade won't make sense. Now, if I'm confusing you, stop me. Just ask a question and stop me. I'll stop and explain it. It doesn't have to be a percent of the account. It can be an arbitrary amount. It could be $50. It could be $75. But for me, just to help, people understand what I'm doing, I'm just saying it's 3% of my account. I'm risking 3% of my account per trade. I'm not sure if it's a daily or not, to be honest with you. But for this sake, let's say it's a daily level. Yeah, I'm not sure. It was already on the chart. But this is what you're doing. All of these decisions, you don't make them while you're in the trade. You have to make these decisions before you even take the trade. That's where this planning comes in. Okay, so your profit targets have to be based on technical levels. Sell it. You good? Yeah. Okay. All right. And again, like we said, they have to have a proper risk-reward ratio. And then you have to determine what's going to happen after your first target is hit. Here's the biggie. If you're scaling out, I know when I scale out, after I hit my first target, my stop automatically comes to break even. My hard stop. My hard stop comes from, I move it from my max loss and automatically put it on break even. What that does is it forces me to not lose any more of the profit I got. Whatever the profit is I got on the first cover, I'm not going to lose it. Yeah, we may lose a little bit to slippage. Sometimes I may set it a couple of cents before, just in case. But the key is, once you lock in profit, you don't want to give it back on the same trade. So, and you kind of saw that today on TGT. I don't know why I can't remember this stock. I probably just want to forget it. All right, can y'all see the chart? I don't know, sometimes when I bring the chart down, you can't see it. Okay, good. You can see where I got in. I knew my plan was on this trade was I wasn't going to get in above the 200 moving average. And if this came down and closed back above the 200, I was going to take the trade off. So I had my max loss set. I had my technical stop. This is a mental stop. This is what we have to have some control to feel good about ourselves. So why not control your technical stop? You got a max loss stop to save you in case you go brain dead. But my technical stop was a close above here. My max loss was protecting my account, and so I got in here. I covered some here. My first cover, my target was right here. You can't really see the white line right now, but this was my target down here. It never did reach my target, and we just kind of bounced around. I didn't take anything off. We were still below the 200. We were still below the 9. So my trade plan was still in play. But once we recovered, I could have taken it off when we were making higher lows here. But we were still under my technical levels. So I wanted to give my trade plan time to work. And it kept going, and stopped me out right here. Right back at break even. So whatever little bit of money I made I locked it in when I got stopped out at break even. Now, what if I didn't stop out at break even and this thing kept going? Which is what this thing did. It kept going. Then I would have gone from being up to being down big. So you have to know what's going to happen once your first target is hit. Are you going to take it all off? Are you going to take half off? Are you going to take 2/3 off? Are you going to take 1/3 off? That's got to be determined before you take the trade. Now, when you get a little bit better, you get a little bit more comfortable, and you may be able to make changes to it based on your price action, based on you reading price action and all of that. But in the beginning, when you're learning and you're trying to get comfortable doing this, you can't do that. You have to stick to the plan that you set. If your plan was to take profit here, take half off here and half off at your final target, that's what you focus on. But that plan has to be in place before. Now you've got your plan, it's time to execute. When the entry triggers, you got to jump on it without even thinking about it. That's the kind of confidence you have to have in your setup, in your strategy. When the entry triggers, you get in. You set your stop where you know it's got to be, and you focus on hitting your targets. That's all you do. You don't look at your P&L. You don't look at what this person's doing, what that person's doing. You focus on hitting your targets, whether it be your stop or whether it be your profit targets. Hopefully it's your profit targets that you're heading towards. And you just hit your marks. You get to your first profit target, have your order all ready to go to take off X amount. Now, if you have enough buying power, set your stop and then set an order for your first profit target. Sometimes it'll hit before you know it. It's happened to me several times where I didn't have an order sitting there. It traded there and it might have triggered my order, but then it never did come back. So if you have the buying power, go ahead and put the target there. And just wait and watch for it to hit the target. And what you want to do is you start monitoring the price action because you're not thinking about how much money you're making. You're not thinking about how much money you're down. You're focusing on hitting your targets, and you're watching the rhythm of the stop. And once that rhythm changes, once you're able to learn how to detect the change in rhythm of the stop, that's when you can start amending your trade plan in the middle of a trade. But until you can get that feel, you just hang in there and you hit your profit targets. I don't know, you guys were following Eric this morning when he was trading URBN, and you see it took a long time to set up as well, but he has the patience to wait. He's monitoring the price action. He's looking for a change in the rhythm, and he felt the change. He felt it change a little bit, and it did try to pop up, so he took it off. But then that pop-up got sold off real quick, and then it made the move. But see, he was watching the price action, and he was trying to get the rhythm, and he kind of detected a change in rhythm and felt that it was time for him to take it off. Now, it could have been that he was losing patience and he started seeing things that really weren't there, because that happens to us. It happens to me. And it might have made him feel the rhythm change even more. I mean, that happens. But the key is, when you execute, all you're doing is concentrating on entering when you're supposed to. When it triggers, enter, and then hit your marks. That's it. That's all it takes. And then lastly, you finish. Now the finish is where the reflection and the journaling comes in. If you don't do a journal, you need to. You don't have to subscribe to TraderView or any other type software. You can do this on your own. All you need to have, you write the date, the time you took the trade, the ticker you traded, the entry price, the exit price. If you scaled out, the time and the price that you scaled out, what the market condition was the SPY, you could write, was the SPY above VWAP or below VWAP, or was it trending up or trending down? However you want to describe the market, you do that. You want to describe what happened in the trade, then you want to evaluate the trade. Was it a good trade for you? Did you do a good job? Did you do a bad job? You got to be honest with yourself. Analyze what happened during the trade. What conclusions did you come to? And then, what are you going to do the next time you get a trade similar to this? We all know that no two trades trade alike. Even though you're trading the same strategy, the same setup, no two trades are going to be alike. So they're going to be a little different. So you want to make sure you understand that what happened here may not happen identical here. But what happened in the trade that you won on, there's some things that may help you stay in the trade in the next trade that you're in, that may help you, get more to move. So journaling, we all said it's going to help you eliminate your mistakes, identify and eliminate your mistakes. It's going to help point out what you're doing right so that you can repeat that. And it's a system of checks and balances. The one thing, and I was talking to another trader today, one thing is you're going to have to learn how to hold yourself accountable. When you're learning and you have somebody helping you learn and working with you, then that person can hold you accountable. But eventually you're going to be on your own and you're going to have to hold yourself accountable. And journaling and using that reflection model in your journaling, and I shared both of those with you last week, it's going to help strengthen you as a trader. It's going to help strengthen your decision making. It's going to eliminate some of the over trading that you do. All right, so I just took you guys through, an anatomy of my trade, what I do, what I look for. And, I suggested to you that this is what you should do as well, but that's just part of the teaching process. If it doesn't fit you, if it's not comfortable to you, then you change it, you develop your own strategy, and you continue to grow from there. Like everything that I have down in this journaling, you may want to put two or three things together. And that's fine. You have to make it your own. All right, you guys have any questions? You know what? That's a good question, Mike, because I was terrified to short. I was terrified to short. But as I developed as a trader, and as I would take my long trades, over a period of time, I started seeing shorts. And I would see the shorts. And then I started taking them. And then, the market kind of started getting bad. And it's easier for a stock to go down than up. So the shorts were just working out. And now I have a hard time going long. But, it developed. I didn't just automatically become short biased. I was long biased. I was the most long biased person you ever want to meet. I was terrified of shorting. But it just developed. It was those baby steps. As I began to spend more time studying my long setups, the short setups just started hitting me in the face. You said if volume slows to below 5K per minute candle, but you believe the stock is setting up. You can anticipate volume to come in, but I would like to see it. I would like to see volume. That's one thing that you can't fake, is that volume bar. You can't fudge that. That's going to tell the truth. So, when you see, you will want to see more volume coming in. If you think it's setting up and the volume is still stagnant, then I probably wouldn't jump in. Oh, if it's 5K per 5-minute candle, no, I wouldn't even look at it. If it's only trading 5,000 per 5-minute candle. Oh, 50K, yeah, that's different. Yeah, 50K is different. That's a whole new ball game. About the AAP trade I took this afternoon. All right. Let me pull that. Let me go to this afternoon. All right, so I've been waiting on this thing all day, and I waited for it to crack below the 20-day. That's what I was saying all since 3 o'clock. I'm waiting for it to crack below the 300, the 20. So once we got to move below it, I didn't take it, because typically you're going to have another candle to come back and retest this, and that's what we got here. It opened and it started to sell, and I was thinking, oh well, I just missed it, and then it got bought right back all the way up through 92. But you know why this happened. You can almost guess why this candle happened. What do you think happened here? A lot of people piled in short. People have been waiting for this stock to break down all day. If they didn't pile in here, they piled in here. This took out it took out some stop orders here. And then we came back and made the move down. So I waited for this candle to trigger. And you see, I didn't get in until right here. I got in on this candle right here. All right, did that answer your question? I mean, you can type it in main chat. You don't have to PM me. You can type it in main chat. I'll answer it here. But I didn't get the move I wanted. I wanted it to go all the way back to VWAP. You know, but once we made a higher low, it was just time to dump it. And I wasn't going to play with it anymore. If this thing was going to go to VWAP, we were going to get a solid move straight down to VWAP. And it didn't happen. All right, so I'm going to stop the recording here. I don't want it to be so long that I can't upload it.